Well, ladies and gentlemen, good morning and welcome to the Experian Quarterly Business Credit Review for Q2 2023. My name is Gary Stockton. I work here in marketing for Experian with Brody. And before we get started, I want to cover just a few housekeeping items. If you would like to follow along, we've dropped a PDF of the slides in the handouts area. If you've got your phones out, you can scan that barcode there just to get a quick copy of that. We'll also be sending a link to the slides in our follow-up email and a copy of the video recording and a link to the YouTube recording as well. During today's webinar, we'll be discussing key findings in the Experian and Oxford Economics Main Street report for Q2 2023. The report was just released last week and I've placed a copy of it in the handouts area. If you want to snag that now, if you haven't already got a copy, you'll be receiving email about that here in the next few days. Today's talk will be presented by Brody Oldham, Vice President of Commercial Data Science for Experian, and Ryan Sweet, the US Chief Economist for Oxford Economics. Brody leads a team made up of consultants, data scientists, modelers, and engineers who provide clients with leading-edge analytics-driven information solutions. He writes and speaks on behalf of Experian about trends in credit markets. Ryan Sweet is the chief US economist at Oxford Economics. He's responsible for forecasting and assessing the US macroeconomic outlook and how it will influence monetary policy and financial markets. Ryan is among the most accurate high-frequency forecasters of the US economy, according to MarketWatch and Bloomberg. And prior to joining Oxford Economics, Ryan led real-time economics at Moody's Analytics and is a member of the US macroeconomics team. We encourage you to submit questions during using the Q&A applet in the tool panel. We'll try to leave some time at the end to answer them. If we don't get to your question, we will be routing them to our experts and responding via email following today's webinar. And now I'd like to turn things over to Mr. Ryan Sweet from Oxford Economics.
All right, thank you very much, Gary. It's a pleasure to be here. For our discussion today, I think there's going to be three key takeaways. First, a lot of forecasters are abandoning the recession call. I think that's premature. We still have a mild recession based into our forecast that will occur second half of this year, early next. And there's a couple of reasons behind that. First, the tightening of monetary policy. Second is the tightening in lending standards, which hasn't hit the economy yet, but it will affect the economy later this year, early next year. And then also on top of that is the past tightening in financial market conditions. So there's a lot that's going to hit the economy pretty shortly. And you can see that on the first slide. And this slide is showing you our business cycle index. And this is why I think a lot of forecasters are abandoning the recession call, is that the economic data is coming a little bit stronger than people have been anticipating. You know, job growth, retail sales, industrial production. And what we did here is we took all of the indicators that the NBER, the National Bureau of Economic Research, looks at in dating where we are in the business cycle, and we combined it into one index. And you can see clearly on the towards the right hand side, things have picked back up. However, I'm a little bit skeptical about this, and maybe this is just being an economist, but response rates are down across a lot of key economic indicators. And I think that's kind of skewing where we are in the business cycle. On top of that, we're going to get a lot of revisions. Like, economic data isn't perfect, so we're going to see a lot of revisions to historical data. And you can see that on the next slide. One thing that we did is we took all that prior approach and applied it to different parts of the economy. And you'll see this in the next slide. But The services part of the economy, where small businesses are key, is doing really, really well. The service part of the economy is doing well because we're still seeing this ongoing shift or normalization towards good spending, so stuff. During the pandemic, Brody, Gary, and I, and everybody mostly on this call, spent a lot of things on goods online versus services. Now that the economy's reopened for a year, 2 years, we're now shifting back towards services. So the services part of the economy is doing well. Goods is struggling. And that's why on the next slide, you can clearly see that the economy is starting to show signs of weakness. This is our looking at leading indicators. And leading indicators is a number of things. It's consumer confidence, it's housing permits, it's a bunch of things that typically lead where we are in the business cycle. And you can see that leading indicators suggest that the economy is about to contract. Again, we got to take this with a grain of salt. Historically, it's been a very good predictor of where the economy is headed, but right now it doesn't necessarily mean the causal relationship and the correlation may not be as strong as it was once in the past. But still, all signs, there's some ominous signs that the economy is showing signs of some weakening that's going to happen in the next 6, 9, 12 months. And if you go to the next slide, one thing that we want to do is we took our business cycle index, which we saw on prior slides, and this is just taking all the indicators of where we are in the business cycle. And anyone that took Econ 101, I know it's early for many people, and we don't bring up Econ 101, but where we are in the business cycle, you can see what we did is we passed this on to our industry team, and they replicated exactly what we did for the US economy, and we can put where every industry is in the business cycle. And on this slide, we're just showing you that a lot of industries are very close to contracting. So this gets back to the idea of how this cycle is going to be a lot different than the last two. The last two cycles were different because we had a financial crisis where everyone went in at the same time, a pandemic, everyone in at the same time. This time around, people are going to, or different industries, like look at construction, for example, are going to experience a recession differently than in the last several cycles. This is more of a rolling recession. So this is why I think this chart of anything that I show you today is the most important, that industries are going to experience different parts of the business cycle than in the past. Those that are most interest rate sensitive, construction, for example, is contracting. If you look at durable goods manufacturing, they're set to start contracting soon. And this is key because businesses are going to experience a rolling recession this time around than in the past. And if you go to the next slide, so there still is a path to a soft landing, and a soft landing is where the Fed brings inflation down to their 2% target, keeps the labor market tight. But this chart here is a little bit noisy, but it just highlights how tight the labor market is. And the labor market is doing really, really well. And this is one key aspect. And in the next slide or two, I'll show you the other path to a soft landing. But this is key. The labor market, if you look at job openings, job or layoffs, by any metric, small businesses, for example, are having a very, very hard time finding workers. Therefore, they're going to hoard labor. And that's why I think this time is different, in the sense that I keep saying this time is different. I know I'm repeating myself, but I think it's important to highlight that small businesses, for example, are going to keep workers on their payrolls longer than they have in the past. They're not going to, maybe they cut hours worked a little bit more than we've seen in the past recessions, but this time is different in the sense that it's very, very difficult to find workers. And you can see that in this chart here. If you look at the quits rate, job openings flows, if you look at initial claims, everything signals the labor market is very, very tight. And that's what we're seeing with nominal wage growth, when you're seeing it in job leavers, the quits rate, everything signals that the labor market is very, very tight. On the next slide, this just highlights here how strong the labor market is. The red line is the reemployment rate. So this is how quickly people are finding new jobs. It's weakened a little bit over the last several months, but it's still, people are finding jobs very, very quickly. And the blue line on the right-hand scale is the job losers rate. Overall, the takeaway from here is very, very clear that the job market is still very, very tight. And this is key to the economic outlook. If we're going to engineer a soft landing, which the Fed hasn't done since 1994, it goes through the labor market, and then on the next slide, it goes through inflation. So if you look at nominal wage growth, which we created a wage tracker at Oxford Economics, there's no perfect measure of nominal wage growth, so we look at everything: average hour earnings, the employment cost index, and we modeled it based on core services inflation excluding housing, which is the Fed is very, very attuned to. They're paying very attention to, and you can see that there's a very strong correlation and causation between the two. Brody, Gary, and I, when our wages go up, what are we gonna do? We're gonna spend more on things that are excluding housing. And that's what's driving inflation right now. So last year and the year before then, it was more supply driven. That was, supply shocks because of the pandemic. You had supply chain issues, which drove up prices for goods that you and I were buying on Amazon or anywhere else, Walmart. Then the next issue was it was because of the supply chain issues. that was one problem. The next issue is now, and going forward, is going to be labor demand and labor supply and rebalancing that. And that is occurring. And you can see that in this chart right here. So the takeaway, the key takeaway from this chart is that inflation should continue to moderate. And this is why the Fed should pause. And if you're in the next chart, you can already see this. When people like feel comfortable about quitting their job, wages come down. And when wages come down, that means you're going to see some disinflationary implications. Services inflation is going to come down, and you can see that people are feeling less comfortable about quitting their job. And this is key. Not necessarily, I'm not rooting for a recession, but when people are less comfortable about quitting their job, that's an indication about the health of the economy. We do have to take this data with a grain of salt because the response rate, which Brody and Gary and I have talked about a lot, is this data is a little bit skeptical. I'll give you a little bit of a quiz. The response rate today is 30%. I think it's actually 33%. 2 years ago, it was 70% for the JOLTS data. So therefore, we have to take this data with a little bit of grain of salt. But in the end, there are signs that the labor market is softening, and I think that is key to what we're seeing in the Experian data.
Okay, Ryan.
I know I'm going long, Gary. I know you're going to yell at me.
Yes, I think we're running up against a time crunch here, my friend.
Turn it over to Brody.
Okay, let's go. Brody, I've got you on deck here.
All right. Well, as we're listening to Ryan and the challenges that are being had across the macro environment, we're going to delve a little bit deeper now into what we're seeing from a credit market perspective, looking at the consumer credit market, then diving down just another level into small businesses and how they're performing in the US. Now we're going to talk about some of this K-shaped challenge that we're seeing across the market and different trends, some segments performing better than others, and we're going to look at why that's happening. So Gary, let's go to our next slide. So when we think about the types of data that we're going to bring together, we think about why we do it. And why we do it is, here at Experian, and when we think about it, the way that we're addressing the market, we really put small businesses first. And small businesses include owners. So that comes with a consumer that's part of our evaluation work, the way that we structure scores, the way that we structure data, and the way that we present insights to all of you as we go forward. So getting that consumer, that small business visible to you, so that you can make a credit decision and continue to fund these small businesses. Now, small businesses make up about 99% of all businesses in the US, and that means that this is critical in evaluating the trends, seeing which outliers are really struggling at this point, and providing some additional support and help. And that's a lot of what our data does. If we go to the next slide, Gary, what we're evaluating are our Experian commercial credit database. And that's made up of millions of businesses. We're talking 30+ million businesses, a lot that are active, that are moving across different segments. We bring all that together. We're able to look at the transactions, what we see in their payment history. We put that together with non-traditional data, and we're going to provide some of those insights to you today as we combine this data together. So let's go to the next slide, Gary. What I'd like to start with is our consumer. So our consumer really impacts how a small business will operate in the US. And we look at the lending market of consumers and we look for where they're spending their money, where they pulled back some, and look at the reasons why. And some of you, if you've been out shopping for a house or looking for a car over the past couple years, you know it's a challenging market. Now your home values and your car values may be high, but once you sell that and get the funds from it, going out and buying a new car can be even more difficult and challenging because the rates have gone up so much that, you know, when we look at the percentage of consumers now that have a car payment over $1,000 a month, it's greater than 10% of all the cars that are on the road. That's a big deal. That means that consumers are taking on a significant payment. And some of you that have bought a new car recently know that's true. Some of us that have kids that are 16 years old, 17 years old, you're buying their first car or their second car after they've wrecked one. That can mean that you're paying a little bit more than you expected, and certainly it can put a crunch on your ability to repay debt, as well as your power to go out there and continue to spend. Now that power to continue to spend is a big deal, especially for consumers. As their utilization increases, you probably heard this story in the news, certainly from a credit perspective, we're seeing that spend has continued to be pretty strong. What that means is as consumers spend their savings down, and they've certainly done that, we're going to see more utilization on cards. And that means that as that utilization goes up, what happens to credit scores? They go down. Does that mean that a credit market's tightening on its own, or does it mean that the consumer's putting themselves in a position where it's a little harder to repay debt or have that power to buy as they go forward? It really does mean that. So we've seen consumer scores begin to come down post-pandemic. You know, there were some moratoriums in place that kept delinquencies at a current level during the pandemic. Some of our scores had risen just a bit. We've seen in the past year that those credit scores on average on the consumer side have started to come back down. Started to come down, you know, pretty moderately over the past 2 months or so, but from a 714 average credit score in the US down to under 710, pretty significant shift as we go forward. And that means the delinquencies are coming up. We're seeing utilization come up for consumers, not quite past that 33% utilization that impacts the score, but approaching that around 28% on average. So we're watching that very closely from a consumer perspective. You can see here on the right that delinquencies have leveled off a bit. That's good. Consumers feeling a little better, getting some legs under them, you know, as wages continue to keep up as much as they can with inflation. We've seen some good wage growth. That's allowing consumers to continue to pay their debts as they go forward. Credit markets have still been open for the consumer. That means that credit's still available to protect some of that cash flow and allow them to continue to pay on the debt that they're servicing at this point. So when we talk about the consumer, then we're going to talk about some of the pressures that have been on consumers. Let's go to the next slide, Gary. So when we think about some of the pressures that are out there, some of that pressure has been released, and that's great. Some of you have seen it. If you've gone to the gas pump, I think we all do more than we want to. You go to the gas pump, you can see that fuel prices just for regular conventional gasoline have been rising over the past year. We've had some conflicts globally that have created some crunches on supply, just challenges out there. We've looked at different country policies coming together to limit supply, and that's really helped to keep the barrel price around $80 a barrel. That's good. That's good. And keeping it moderate and stable has kept our prices starting to level out a bit. We've seen some pullback on pricing, so where it was above $4 on average a gallon here in the US, that's come down a bit. We're now around about $3.80 per gallon. That's good. Now, where we generally see, where I put this purple line here, is at about $4, that's when we see the EV sales really take off. So electric vehicles have been a big thing over the past 2 years. Really a big push toward that green feel and moving our automobile industry toward the EV. Seeing that gas price above $4 really makes the consumer consider if they should make that move as well. So we still see it below that level, but it is beginning to bounce just a bit and come back up as we watch global supply have a little volatility here, and we'll continue to see that through the end of the year. Now, when we think about consumer as a whole and we look at inflation impacts that are pressuring them, you can see that energy prices have come down a little bit. We just talked a little bit about that. Food prices have come down slowly, but we are seeing them have some pullback, some deflationary kind of feel to them, and that's good. That allows eggs not to be $8 for a carton, Now they're down to around 3 or 4. That's very helpful for families as they go out and feed their families on what their current wages are and how they're moving within the economy. Keeps our spend moving a bit. Shelter's still pretty high and pretty consistent. That's because home prices haven't come down really at large overall. We are seeing some reduction in home prices, but not impacting rentals at this point. We're going to see some pullback in that, but it's not going to be as quick as we'd like. But for a consumer, any break here that we see in food and energy is certainly going to help them. And you know, as you look at that across, we've seen some student loan relief also over the past two years. That's certainly taken some payments off of their monthly obligations for a consumer and kept them, giving them a little bit more space to spend. So when we think about the consumer at this point, there's a lot of positives that lead them to continue their behavior and continue to spend. So Gary, I'd like to pull up a slide. Let's go to the next slide real quick. And I'd like to pull up a survey. And the survey is, are small businesses experiencing their own recession? So I'd like you guys to think about that for a minute. So we've talked about consumers. We're thinking about consumers doing pretty well. They have some advantages here in some of the pressures being released from them, so their ability to spend, they've continued to spend. How are small businesses feeling as consumers' ability and their power, their spending power slows? How are small businesses feeling, and do you feel that really we're in that rolling recession at this point, or it's approaching? So are businesses experiencing their own small business or their own recession? Gary, let's take a look at and see what we have so far as responses.
Okay, I'm going to close the poll, guys. Looks like we've got about half of you to engage in the poll, but with half, and let me share this. Can you all see the poll results? I'm looking at 69% yes, 31% no.
Very interesting. Again, feeling that from a small business perspective, that small businesses are feeling some of that pullback and what their really their ability to engage the market and consumer spend within the market. And you think about these small businesses that are out there, when we think about a recession, you look across a broad spectrum of businesses. It goes all the way from micro and sole prop types of businesses, all the way up to small, medium-sized businesses that may have 50 or more employees, up to 500 employees. I mean, it's a big range there that we look. And so as we look at some of these that are very niche in their products, we're going to see more impact to those as discretionary spending slows a little bit, and we see consumers move back to the core, still spending. Inflation means that they can still spend, they just can't buy as many units as they might have bought in the past. So fewer units, but still out there spending, and that's going to impact some of our industries as we go forward. Now let's look here at the credit trends for commercial credit, because we want to see really in the trends, when we dig into our commercial database, is lending slowing for the market for small businesses? Is it staying about where we would expect it to be? And we take a look, if you look at the left-hand side of this slide, you're going to see credit card originations at the top, installment types of loans for small businesses at the bottom. Where we are right now is in a cycle, in our normal cycle that we would see as the environment is kind of cooking along. We want to see some ebbs and flows in loan originations. They're continuing to progress even as rates for these types of loans go up. We still see that small businesses are out there seeking credit. That's good. That means the economy is still cooking along. Businesses haven't pulled back yet and said, we're not looking for funding. Larger lenders and lenders haven't really pulled back to say, we're not going to grant you that funding at this point at the current pricing. So that the market is still open and churning. Now, where are some of the challenges in the market? If you look in the top right-hand side, you're going to see small businesses, and we talk about this a lot. 33% of the portfolio held at Experian, all the businesses that we're monitoring, are small businesses that are less than a year old. These new businesses entering the market, there's a lot of them. That means they don't have a lot of credit history. The rates that they're going to get for funding are higher, and they're going to have a little harder time as the economy slows getting to that funding that they need, or having investors come in and continue to put money into a business as the economy slows and cash flows slow a little bit. Now, we're still continuing to see consumer spend. You can see in the middle chart, the blue line is consumer confidence. It's been coming up over the past couple months. Small business confidence, kind of that sentiment around how they feel about the economy, has been pretty steady, hasn't dropped down significantly, and we even see a little bump over the past months. That's good. We continue to see consumers and small businesses feeling a little positive about the end of the year. When we look at delinquency rates, we've seen them go up across different regions. Now the southeastern regions are where we're seeing delinquencies hit the highest. Really at the beginning of the pandemic, when we had that big influx of new businesses that came into the market, a lot of lenders didn't know what to do with these. They were originated in some cases, maybe taken on as promotional types of campaigns to bring these small businesses in and lend to them, even though they were less than the standard 24 months in business that lenders usually lend to. We're seeing some of those delinquency rates rise. The South and the Southeast is really where we saw these new businesses start, where the bulk of them started. Now that's spread out across the country now, but in the very beginning, the South and the Southeast is where we saw a lot of that really fertility for small business starts really hit. Gary, let's go to the next slide. So we're thinking about small businesses, how they're performing. Now, which segments of small businesses, if we look from last year to this year, are being challenged a bit? We're going to see it in mining. Now, if you've watched, it's a challenging market. We have fuel prices that have been a little more volatile, supply chain challenges there. Certainly exploration and leasing has been a challenge for the industry, trying to find new ways that they can engage. Some of the ESG types of regulatory kind of engagement has created an opportunity for them to try new things. And so in doing that, it really takes them and puts, some of these smaller operations in more of a challenging position, trying to figure out who they are and where they're going to be. And also with the volatility in price, are they able to go out and buy equipment? Are they holding onto equipment a little bit longer than they probably should? Waiting for the market to change, waiting for those oil prices to go above $80 a gallon for them to begin drilling again, and that's causing some delinquencies, certainly in some of these markets as they're a little bit more volatile, certainly in mining. In the public sector, you think about interest rates getting higher, they're servicing a lot of debt that's there, they're going to have some challenges again, looking for some of the infrastructure funding to come out, not all of it's flowing to the places that were expected. And that, again, everybody thinks that money is coming to them. Not everybody gets it in the time that they would expect. And so we see some of these public administration focused segments having a little bit more trouble as we get into our third quarter and potentially into the fourth quarter. But we are seeing some of that funding already beginning to flow into the segment. So we should see some improvement toward the end of the year. So let's go to the next slide, Gary. So when we think about credit tightening, why don't we pull up that next poll, Gary, that talks about the environment that we're in right now. We've talked about delinquencies rising a bit. We've talked about some of the credit markets being fairly open. So how are you feeling about the current environment? And has your feeling of a recession toward the end of this year made you adjust your credit policy a little tighter? Are you looking at adjusting your policy as we go into the next couple months? What's your plan? Or are you holding back? You're saying it's not really time. I'm looking for the opportunity at this point. I have a feeling that we're going to take back off again, and so I'm not adjusting my credit policy. Let's take another few seconds here, and then we'll look at what Experian is seeing on our data, as well as what we're seeing from the SLOOS report and some of the other insights that we see out in the market. Showing us what's happening within credit policy. Gary, why don't we take a look and see what we have here?
Okay, we'll close the poll. It's about 62% participating in this poll, Brody, and I'll share the results.
Credit tightening, I see. So very interesting as we look at it, because I'm going to show you something here when we think about tightening policy and what we're hearing, certainly from the Fed and their surveys that they're doing as well. We're seeing a very similar trend here as far as the expectation of tightening, or tightening current policies as of right now. Now, what I've seen certainly from clients over the past 6 to 8 months has been an evaluation certainly of current policies, what their policy rules look like, what their cutoffs are certainly in their pricing and underwriting policies at this point, and they're adjusting and cleaning and streamlining up to engage customers, maybe not at the same price points or with the same products that they had in 2022. So 2023 has been a little bit different. An expansion of products, a tightening of the core products, and certainly what you might see is that with really a crowded funding market, so we've had still investors in the market, we still see that other players are entering, so credit unions traditionally hadn't been in the small business lending space, starting to move into that space, offering products to their members. And you think about credit unions, their big thing is that they know their member. I have a personal relationship with you. My personal banker is here. You're in my community around my credit union. And as a member, we're going to bring you in. If you have a business, why aren't we servicing that too? So we see credit unions entering the space. Fintechs have always been there, but we've seen an expansion of fintechs that are servicing small business lending and just opportunities for other players to get into the market that may not be financial institutions, but are offering products to allow small businesses to be able to manage their cash flows a little differently than they had in the past, a little more easily in some cases, and be able to show to a lender that they have cash flow and that the market should continue to stay open for them. Now, what you'll see on the screen here is a look at the trend in the risk tiers that are being originated for small businesses. And this is looking at all products across the Experian portfolio as a whole. So when we look at this, what we're seeing is that it's pretty stable. We're not seeing a big tightening. So as some of you are looking at your credit policies and you're talking about tightening them down, looking at volumes, limiting that exposure as we go into a bit of a slowdown and some of that rolling recession that Brian talked about. As you're looking at that and you're tightening up, what happens to those small businesses that you may not be funding, originating, binding together into a product as you move forward? Well, what we're seeing is in this crowded lending market of not our big financial institutions, but those that are supporting the market outside of that core space. The core is tightening. What we're seeing is that this crowded group at the bottom, those that are picking up additional, maybe a higher priced product into the market, are picking up some of the slack. And so we're not seeing a slowdown in credit originations, even though in some of these SLOOS reports, as we look at creditors such as yourself saying we're tightening, we're not seeing the market tighten as a whole. Now, is that a good thing? It can be. So here's the good and the tough. So the good is that means that small businesses can still get funding, can still spend, can still grow. It means that consumers can still get funding, can still spend and still grow. It means that inflation still has some upward pressure. It's going to have a harder time for Mr. Powell to bring that down a little bit more as we get into 2024. And coming out of Jackson Hole, they're very excited. There's potential there. We have a strong economy. We're looking at how we're sitting at this point. We look at the up and downward pressure on that inflation number. This is one of those, as credit markets stay open, it's going to create a little bit more upward pressure because of that credit availability, gives some of that cash flow that may not be organically driven from your customers themselves. It's taken kind of artificially from a loan product. So we'll continue to watch that as we go forward. But credit tightening, we may see a little bit more of this hit the numbers here at Experian as we enter the last half of this year. The thing that we're really going to watch for, though, is if the consumer pulls back on their spending. So how many of you have gone to Lowe's? I see a couple of you have raised your hand. I'm just kidding. But as you look at it, Lowe's, Home Depot, when I walk through my neighborhood hardware store, what's been up for a month and a half? Halloween. We've already seen those holiday setups already happening at the end of end caps. We're watching businesses try to get ahead of any slowdown that was going to happen in the fourth quarter. They're getting their products out there earlier, and in doing that, they're trying to capture some of the spend before the consumer really cuts back on some of their discretionary spending. So market's still open, consumers still spending, small businesses still looking for some of that growth as we get into the end of the year. Let's go to the next slide, Gary. So when we think about this, the inventories are out, but we think about the consumer still spending. The power to spend has not been as strong as it was 2 years ago. Not much savings in the bank. You know, we talk about that $2 trillion that was there. It's come down significantly. Then we look at logistic managers, the logistic managers index. We think about how the trucking industry is doing. They're having a tough time. And when we think about this segment of the small business market, this is what Ryan was really talking to. We're seeing this segment pull back, having some real trouble. If you've watched, Yellow went out of business. That was a tough one. One of those half truck type of producers, one of the top 3 in the nation, went out of business. That created some challenges. Why are those trucks empty? Because we see that inventories have really pulled back from small businesses looking at the year, thinking there would be a slowdown. They haven't spent like they did in the prior year to build up their inventory because they weren't as worried about a supply chain crunch as they had been in the past. Consumers aren't buying as many units now, and that's creating empty trucks that aren't full to transport, more point transports instead of going out to individual locations. Are going more to distribution hubs, less miles for the trucking industry. That means less payment. That means they're going to be crunched a little bit more. With fuel prices high over the last year, it added a little bit more to that. Labor challenges, certainly some union pressure there as wages were pushed upward, just created some really thin margins for these logistics types of companies. And so they're going to be challenged as we get into really through the holiday season. If we don't see consumers really pick up spending and move beyond and try to really hammer through what they're seeing from an elevated inflation standpoint as we enter the holiday kind of spend fever as we go forward. Let's go to the next slide, Gary. Now, Ryan did talk a little bit about construction, and there's some good and there's some bad and there's some ugly in construction. Some of the good parts you've seen, like Berkshire Hathaway over the past 30 days start to invest a little bit more in some of these home builders as they look at inventory levels being fairly low. Consumers still buying houses, even though interest rates are higher, just because there's still pent up demand for homes. As we look at, that means that we'll continue to see still some movement. That means inflationary pressures upward are still going to be there from shelter prices not coming down as quickly, because you still see consumers out buying these residential properties, even though the rates are high. That keeps the prices at still an elevated level. We will see a bit of a slowdown in the commercial real estate market. Back to work hasn't been as great of programs, even for us at Experian. Some of you may be going through some of the same things. Not as many people in the office as there used to be. A lot more remote work. That means that you don't need as many buildings or office space or floor space for your business. That means that the really need to have so many properties. That commercial real estate industry with a lot of vacancies is going to create some downward price pressure, and it's also going to slow some of the construction. Even though it's pent up demand that could go for 2 or 3 years, the rates are high enough now that businesses are reconsidering whether they should go ahead with a project or hold off for just a little bit to see if we get some at least leveling off of rates or a decline in rates before they make a big purchase going forward, really reevaluating what they're doing. So as we look at what value this could bring from a small business perspective, construction still will have an opportunity on the residential side and on the commercial side to continue going through the end of the year. That's going to help trucking because you're going to load up those trucks with that construction material. So a little upward pressure, certainly helping logistics as we go forward. So not a total, it's not going to really tank out our trucking industry if inventories aren't kept up from a retail perspective, but it will certainly help from construction. And you think about heading into the holidays, retail sales, what a surprise, again, up again as we're coming into this month. So we'll continue to see that. That's going to, again, help the trucking companies as we go forward to keep those trucks going and keep inventories at least at a level perspective going forward and not dropping off at the speed that they're expected to through the end of the year. So a little upward pressure there is certainly going to help us as we move forward through the year. Let's go to the next slide, Gary. So some of the things that are going to create additional pressures on consumer spend. So when we look at small businesses, remember, spend is going to be the most important part for the end of the year for these fringe businesses, micro, small businesses that make up the majority of the business in the US. What's going to impact some of that discretionary spending from a consumer perspective? Student loan reassumption of debt and the obligation to begin making payments on interest, certainly coming up October 1st. Are going to be the first times that those are going to be reassumed by consumers, by our student loan holders. There's going to be some opportunities through the SAVE program potentially to stretch some of that out. Interest may continue to accrue for the consumer, but you think on average what the payment is going to be for a consumer that has debt is around $400 a month. So $1,000 plus car payment, $400 for a student loan reassumption. You're really putting some pressure on the cash flow of consumers as we go forward. And this reassumption of debt, again, takes away some of that discretionary spending that consumers have been using to pump into the small business market. So we're certainly going to watch that. We're going to see energy rebound. If you're at the gas tank or at the pumping gas, you're going to see that it's gone up from on average about $3.50 up to about $3.80. So that's going to continue to put pressure on wallets. When we talk about drought pressures that are out there, we're talking about hurricane coming through this week, even this morning, some of the challenges there. That's going to put pressure on consumers, certainly in recovery. And when we think about drought here in Texas, it's so hot that my trash cans have melted shut. If you guys have ever experienced that, that is something. Move to Texas and you will find that goggles melt to your pool and your trash cans melt shut. It's pretty significant heat that we're experiencing. That means water is not going to be available for our farmers and for our ranchers. That's so typical here in Texas to hear those kind of things, but it really does impact small business as well, getting access to resources as we go forward. So I think that some of those challenges will impact consumers' ability to spend. Credit markets are going to stay out there, but the price of credit is getting higher and higher. So we're going to watch as utilization on credit cards go up, and those minimum payments that you're going to see on credit cards are going to increase for consumers. That's going to put additional pressure on the consumer as we go forward. So we may see some slowdown here in consumer spend as those pressures increase. Let's go to the next slide, Gary. So let's think about the Fed's outlook. Coming out of the meetings this past week, feeling pretty good about the economy, but leaving the door open for future increases. Our economy is still cooking along pretty good. We're still above the Fed's target of 2%. 3% is around where we're sitting now. Is there a potential to bring that down more? It's going to be tough. The pressures that we talked about today with shelter still being high, home prices still being elevated. We're still seeing wage growth, even though it's normalizing, leveling out a bit. We're still seeing that we are seeing some increases in some segments. Now that's starting to come down. We're seeing some pressure release in the labor market, but not significant enough to really impact. So that's going to keep, again, cash flows moving and consumers outspending. So is there a potential for another quarter increase toward the end of the year? Of course there is. But I think we're holding at this point, as some of the Fed comments were, we're holding at this point. We're going to wait to see as we enter into the fourth quarter. So there's potential there. Now, when we look at it, generally when you see this federal funds rate and your inflation rate inverse, that's when we see the Fed slow down and question really when they're going to make it. Are they going to continue to do increases? Are they going to look for to pull the rate back for this overnight rate? And generally when we see that inflection, we're going to see that the Fed begins to pull back on their quantitative tightening. Now, that certainly is in the cards for us. Now, does that mean it's going to drop back down to zero from a federal fund rate perspective? No. Generally in the past, what we've seen is a gradual release of the federal funds rate. So over the next year, it may slowly come down just little bits at a time, but nothing near the zero rate environment that we had seen in the past. Gary, let's go to the next slide. So let's kind of wrap up what we've seen today. We've seen the fear of a U.S. recession lighten out a bit. We know that there will be some challenges for some segments of small business versus others, but a little lighter than we really expected at the beginning part of this year. A lot of economists were in the boat that we were going to have a really heavy recession coming in to the fourth quarter. That's pushed out, and our expectation is that we may see some industries kind of roll a little faster than others into a slowdown and then may pick back up, really dependent on consumer spend through the end of the year. Consumers are relying a little bit more on credit cards. Utilization rates are going up. Again, not to the point where it's impacting scores at this point, but it's approaching that level where we'll see those scores pull back. Now, credit scores in general, certainly from the consumer perspective, are coming down a little faster than from a commercial perspective. Consumer scores down again from about 714 on average to under 710. So some good movement there from a consumer perspective because of delinquency rates increasing and those utilization numbers coming up. Now, when we look at some of the challenges that consumers will face over the next year, again, we're going to see reassumption of debt payments, monthly obligation payments for a lot of consumers. Their savings is going to be slowing a bit or dwindling to what they can spend on this discretionary spending. But the credit markets are still open, even though a lot of you are tightening some of your criteria. Still the ability of consumers and small businesses to get out there and get a loan. It's just going to take a little longer to find the product that fits their need and the price point that they're really looking for. So as we enter into this next season for us, and hopefully it'll get a little cooler for me here in Texas, but as I look toward the holiday season, we're certainly going to be watching retail sales. And I encourage you, as we get into the next year to follow along with us as we put out a lot of content from Oxford Economics and from Experian to share in some of the insights that we're seeing and to ask us questions. And so, Gary, why don't we open it up? Do we have any questions in the chat that we can address?
Yeah, we had a few questions come in. We've got a few minutes here, folks. There was one interesting question here from Stan about companies asking for unprecedented payment terms. And Stan says, we're seeing more and more large Fortune 100 companies demand unprecedented payment terms, some up to net 180. What's driving that?
Well, from my perspective, some of the things, and Ryan, if you want to chime in on this too, what we're seeing from my perspective is that some of these businesses are taking on more obligations. Certainly from a regulatory perspective, we're seeing that they're asking to create more capitalization within their business to really prepare for any losses they may see upcoming. You're going to have a little bit more regulatory oversight that's going to create a little more overhead expense for some of these customers. And so we're going to see some really margin pressures hit some of these larger players in the market. And so looking for some extension of terms may be out there, but at this point, we're still seeing the consumer spend and be in a pretty good position. We're still seeing small businesses look for credit and still be in a pretty good position. Some cracks there, but still for a large lender, those cash flows continuing to move just at a bit slower pace. Ryan, anything you want to add to that?
Sorry, you were on mute. There we go.
No,
yeah, you're on.
All the points.
Okay. Ryan, there was one question about energy that came up. This is a good question from Andrew. China will not use as much oil and gas, so shouldn't the energy prices start to come back down?
Well, that's in our baseline forecast, right? Our forecast is for energy prices to come down over the next couple of years. And to your point, it's less demand from China. And that's key to the energy forecast.
Yeah.
Well, and what I would add to that too is that we see, pacts like Russia, Iran. We're going to see some of the African countries come together, looking to, certainly Saudi Arabia, looking to keep that oil price up. So they'll reduce some of their production there as well and try to keep it up above 80. Anything you have to add to that?
That's in the near term, I think. In the next, and Brody, I agree with you. In the next year, maybe 2 years,
Yeah.
they keep it, OPEC plus, as said, they want it $90 per barrel. WTI, so forecasting energy prices is pretty easy in the next, 12, 18 months. But longer term, with China slowing, that's when you're going to start to see the decline in energy prices.
Excellent. We've got quite a few other questions. What we're going to do is we're going to put a blog post together with some of the responses from our experts, because we simply don't have enough time for all of them. But really good questions here, several from Andrew, Felipe. So look for that blog post. We'll include a link to that next week. I want to really appreciate if you could please respond to our exit survey. It really helps us improve and keep improving the quality of our webinars. So you'll see that pop up whenever you exit today. And we would like to thank Oxford Economics, Ryan and the team there. They're doing a great job for us on these economic updates and contributing to the Main Street report. For more information on Oxford Economics, of course, it's oxfordeconomics.com. And for Experian.com/B2B, that's us on the internet. Come visit our Commercial Insights Hub. We've got insights about small business coming out regularly. And thanks to you all for attending and taking time out to join us for the Q2 Quarterly Business Credit Review. That's the end of our program today, guys. We will see you back here again, hopefully, for the Q3 Quarterly Business Credit Review, and we'll take a look at how small businesses are doing. Thanks for joining, everyone.
Thank you.